Hey everybody, it's me, the Einsterin on Wall Street from the balcony at the New York Stock Exchange. What a day to be alive, what a day to be in the market, what a day to be able to speak to Dan Ives, who in my opinion is the #1 tech analyst in the world, and I'm not the only one who believes that, because we are at a point in market, in history, in the economy, everything related to the Fed and labor markets and everything. We are in the beginning of May, and I know there's this old adage, sell in May and go away. It doesn't feel right today, but a couple of days ago, it did feel right for a minute. We always talk about the different components that make up this economy and make up this market and all the headwinds that we're going through. We just finished the first quarter, best quarter since 2019. Then we came upon April, which was an absolute disaster in so many different ways, right? It was like we hit up against some technical resistance for sure. We started dealing with what was going on with oil because of the war in the Middle East and obviously with the war with Ukraine and with Russia. We started dealing with the yield curve affected by the oil price and the delivery of oil and all that controversy there. And then we started having these numbers that were a little bit hotter. January and February's economic data was a little hotter. And even though Jay Powell came out and said, I'm not going to pay attention to it, when he started talking 6 weeks ago about the economy, about the interest rate cuts we were going to have, he kind of promised us, in a way, 3 interest rate cuts, 75 basis points by the end of the year. He didn't lay out the strategy on when it was going to happen. But at that point, look, markets can deal with anything. Wars, banking crisis, whatever, they can't deal with uncertainty. That's the thing that markets won't deal with. However, so then, after he was done talking, there was a complete dissent amongst the other governors. They started talking about that the economic data should have been paid attention to, and that we are up against some difficult times, in fact, and that the CPI and the PPI numbers were not as expected. Markets also don't like to be given expectations and those expectations not being fulfilled. So they started talking about maybe 3 cuts. No, maybe 2, maybe 1. And coming into the last week, we actually, we talked about it a couple of weeks ago, that the biggest fear were to be that, look, the tools that the Fed uses have worked. We're down from 8.5% down to 3, right? And as Dan always says, we're talking about the last 5 pounds of a diet here that we can't get from 3 to 2, okay? So then you're suddenly up against the fact that they actually started to discuss potentially raising interest rates to basically tamp down whatever these hot numbers that were coming out. So the numbers were not heading us towards 2%, which is their trajectory goal. And so over the last couple of weeks, that's what really set the stage for April. We had the worst month of the year here. We had a really down April. Now we're in the beginning of May. The Fed meeting, so we're meeting here on a Friday in a week that couldn't be a better week to try and break this down. This is called the Dan Ives and Einstein breakdown, baby. That's what we're talking about. Boom, the breakdown. Boom, drop the mic. Because so much happened this week. We had a Fed meeting, market up, market down, huge sell-offs, huge reversals. The Fed day was absolutely astronomical. We came out Wednesday. Obviously, they did not raise or cut on Wednesday, but what they did do is he took the possibility of a raise off the table, right? He did basically say that the next move the Fed will make will not be one of raising. The market rallied hard from 2 o'clock to 3:30 on Wednesday. The minute he stopped talking in his news conference and everybody's hanging on every word, the market rolled over. It had gone up 85 handles on the S&P. While he was talking, it rolled over and sold off almost 100 handles. So we're here on a Friday, 2 back-to-back days after the Fed meeting of up 500 plus points. Could you tell me what's going on?
Yeah. No, first of all, I think your summary is just excellent.
Thank you.
In terms of just how we got
to Friday, right?
Look, first off, if you look at earnings season, it's been pretty robust for big tech.
Correct.
And big tech really being a leader, very important what we saw Microsoft, what you saw from Alphabet,
right,
Amazon, and Apple. So
Correct.
really, if you look at the fundamental story throughout tech earnings, 80 to 85% are actually beat and raising.
Okay.
That's setting up for just fundamentally, you're just seeing a better, I think, earnings season than many expected. But as you said, the black cloud is Fed rates.
Right.
The one thing you need for them to cut, they need one data point, it's jobs. And if you look at that job number, that was a soft job number, unemployment going up.
Right.
That's bullish because now I'd almost say 25 bips that was maybe priced in 24 hours ago
Right.
for the year. Now we could potentially price in 50 bips of a cut. That's why market's rallying, because now it feels like the cuts are back on the table because the soft job numbers, that's given the Fed the data
that they
could
need to
cut.
do that. Okay, so look, this is so, it's like good, bad is good and good is bad. So you need to explain that to me, because look, we came out with a jobs, the one piece of data that was missing this week was the jobs number. We had PPI, CPI, all that stuff. We had the Fed meeting, we had all that and the market's response to it. But what came out today, we were expecting, right, an additional 240,000 non-payroll jobs coming into the marketplace. Okay, what ended up happening was the number was a little soft. It was only 175,000 jobs were created. We had a unemployment rate that went up from 3.8 to 3.9. So that means that there are less. But isn't there something in the nuance of this that there are more people looking for work, and what's that about?
Well, two things. One, more people looking, which is important, because that
What number tells us that? Where in the report?
So if you look in the underlying metrics, it's based, there's actually how many are looking for jobs.
Right.
That went up month over month.
Okay, so that's a good thing.
That's a good thing, because it's basically going to show the unemployment rate is going to tick up now over the next, call it, few months.
Because more people are looking
for jobs that were not even looking for jobs.
Okay, so it's not that people are not getting jobs, it's that the number of people looking is greater. So it's kind of skewed in a way.
Think about numerator, denominator,
right.
but that's important, even though it's splitting hairs, because the Fed needs to see more people are looking for jobs.
Okay.
Unemployment rate historically 3.8, 3.9 are still very low.
Right.
But you need
so full employment, sorry to interrupt you, but years ago full employment was 4%. Is that
exactly.
correct? So we're good shape when it comes to that.
You're essentially at full employment. And the most important thing is if you looked at wages in terms of the underlying what wages are from an employment perspective, you also want to see wages, that number be slow and tick down.
Really?
So
why? Why?
Because ultimately, because if you look at the inflationary numbers, the worst thing is you want to see prices go up above wages, because that basically means your purchasing power is going down.
Right. But why do we want to see this? So this is so you're talking about a formula heading towards the Fed deciding to cut rates. We're not talking about what's good for the economy.
Because to your point, if you said what's good for the economy, technically, you'd want a phenomenal job number. You'd want
low
unemployment. Exactly. So, but now, like you said, in a Twilight Zone Alfred Hitchcock, what's bad is good, what's good is bad. What's bad. So now, the only way the Fed cuts in Powell and what all the governors are looking for, they need data points that are going to ultimately give them the powder that they could cut.
Okay.
The main thing is the job. That's a huge number that they're focused on. You see that come down like we saw today. Another month or two of that, you're going to then see maybe the first cut, instead of being November, December, potentially being in the fall.
In September. Okay, so we produced less jobs. That means that companies are not hiring as much. Okay, so that shows a little softness in the economy. Okay, so then you've got unemployment ticking up a little bit, and so that says, but explain to me why is so, okay, so it's a fascinating formula because you think about it. So less jobs were produced, more people are looking for work. This is pointing towards a softer economy, which gives the Fed the powder to say, okay, we're going to cut rates. The market likes the fact that we're going to cut rates, because the day on Wednesday when he was really talking about the fact that we may not have any rates cut in 2024, the market did not like that. So why is the market up 500 points today? Is because the economic data, that piece of the puzzle that came out today, is maybe giving the powder to the Fed to say, you know what, we're not only going to cut, we are going to cut in fact in 2024, and we may in fact cut a little more than we had anticipated 24 hours ago.
Exactly. And then and I would just add to it, if you triangulate it with earnings,
Right.
Starbucks, you know what I've used as a staple for many?
Right.
Very weak numbers.
Very weak
because
number.
What's really happening is even their core consumers, their core customers,
Right.
they're pushing back on just how expensive a lot of these drinks are.
Okay.
So
And is that a recent occurrence? Because look, for the longest time, we know, look, everybody sits around and jokes about the fact that a latte is $9 and how insane that is. And when everybody's robust and your economic forecast is good and the consumer's balance sheet is frothy and good, then nobody's thinking about a $9 cup of coffee. But when things are not so well, we do.
Look, you're the famous Tuchman pizza that everyone knows, okay?
Right.
For $16, if you were making the pizza,
Right.
I'd be all there.
Right.
If you were trying to sell me the Tuchman pizza for $32, I'd
Right.
be like, you know what? I'm going to go somewhere else.
I'm going to Domino's.
So there's a point, and we're starting to get to
tipping
that
point.
point
Right.
where maybe those price increases that keep getting passed through the consumer, they're starting to slow economy, and that's ultimately in that cycle, that flywheel, how prices come down. But it goes back to you lost 30 pounds.
Right.
Phenomenal. That last 5 pounds
Right.
is so hard, and that's right now the challenge of the Fed.
Okay, but you're talking about consumer staples. Is Starbucks considered
I'd
a consumer?
consider consumer
Okay,
staple.
so consumer staples are struggling because economy is softer and people are less likely to spend $9 for a coffee. We may be at that point where people start to pull back on consumption because they don't have as much disposable income. But you then said that the tech sector are coming out with super solid earnings. And kind of explain to me why we saw Tesla come out with really terrible earnings and that went up. Meta came out with reasonable earnings. They went down, right? And so you're seeing once again good is bad and bad is good within tech. Can you explain that to me?
Yeah. So overall, AI exposed names,
Right.
Microsoft, Alphabet,
Right.
Amazon,
NVIDIA.
and of course NVIDIA that we'll get in a few weeks. But then when you look at Tesla, electric vehicle demand's been softer.
Right.
That stock's really been a huge underperformer this year.
Down 40% year to date until a few days ago.
Exactly. And then really that was finally Musk being the pilot on the plane
Right.
and not Ted Stryker as the pilot to actually show.
Shout out to the
Airplane.
airplane movie. Yeah.
And that's why Tesla now, you're going to have a cheaper vehicle that's going to come into next year.
That was the news. So they tossed us out a little bit of a carrot. They came out with, sorry to interrupt you, they came out with shitty earnings, okay? And so net, the stock should have gone down, but coming into this year, the stock has been down 40%. So the stock had gone from 200 plus down to 140 coming into the earnings. So there was once again another component. So not only were there bad earnings, which would have taken the stock down, but the stock was way oversold. But then again, we got two little carrots by Musk, which said basically we're going to fast track the robo-taxi and we're going to come out with a cheaper vehicle. Is that what made them?
And then Musk this past weekend, made the surprise trip to Beijing.
Okay, that I
and
didn't know.
he got
Okay.
full self-driving essentially approved in China for Tesla.
Okay,
so that
that's
was
huge.
a huge. So if you think about this last
That was that
week,
second catalyst.
that
to
was the
stock,
second
really.
catalyst.
Okay.
Now then, when you look at Meta, which has been a missile ship in terms of as a stock,
Right.
Zuckerberg basically talked about how much they're going to spend incrementally. They're going to spend like a 1980s rock star on AI technology.
They are.
Now that's
had not been talked about
not been
before?
talked at that level.
Okay.
Now investors fretted about it at the time, but I continue to view that is the smart strategy.
Okay.
And who benefits from that? Microsoft, Google,
Right.
Amazon, NVIDIA,
So is
AMD.
Meta considered having a large AI component, or is this something they're now
I
delving
think
into?
it's something that they're
It's about to.
Just like Apple's going to talk about it next
Right.
month at WWDC,
Right.
in terms of the developer conference. Now the consumer piece is starting to go after AI, being led by Meta
Right.
and Apple.
Okay. Oh wow. Okay, so that's fascinating. So I need a little more explanation too. So, look, April was really a rough month. Okay, so can you give me a breakdown on what did you feel were the major components? Was it the uncertainty? I know markets can handle virtually anything except uncertainty. They also can't handle expectations not being fulfilled. Was that what April was about? Or so are you saying, because I know you walked by me the other day and I mentioned it in a number of posts that I put out, was that you said Ives is eating popcorn and I'm a bull, right? That was that mid-April sell-off, and you were still confident in the eyes of that sell-off that we saw in April. So what was April to you?
Because to me, it was really you've had a massive move in tech in the market through the first 3 months of the year.
Right.
So digestion, some profit taking.
Okay.
You have a 10-year basically Fed jawboning that goes up from 4.3, 4.4. So then the worry was you could see potentially a 5% 10-year. Equities gets crushed.
Right.
2, I think if you look at geopolitical, Israel, Iran, that was worry about what that means in terms of just overall oil prices.
Right.
And then as oil prices go toward $100, the Fed essentially back against the wall. They can't cut when oil's $100.
Right.
So now look where we are today. Oil's $75.
Right. It came off its highs.
Fed basically that 10-year instead of 5%. That thing's now 4.4. Maybe potentially going to 4.3. You had tech earnings that were Jalen Brunson-like in terms of overall what we've seen there. Put it all together right now. I view it much more as this is the start of the next trend higher.
And this was
April
was a one-off.
And April was just a crazy turbulence.
Right.
And then all of a sudden you're drinking champagne after you navigated.
Okay, so think about it. I always talk about that the market can handle virtually anything, one at a time. But when it's confronted by things, multiple catalysts create a perfect storm. So you're saying April wasn't perfect. You just described it in a beautiful way. That you talked about all of that, about interest rates, about the geo-global problem, about the yield curve, about oil, about the wars, and all of those things contributed to profit taking from a great quarter. Why wouldn't you?
And also you have to remember a lot of the bears that have been, if these bears were, many of them that have been dead wrong in the market for the last 15 years, if they were draft analysts, they'd probably be negative on Tom Brady coming out of 2000 draft out of Michigan. So the point is, look, when things like this happen, those bears, they're deep in those caves in hibernation mode.
Right.
They come out saying, this is the moment, it's ending. And guess what? Now, here we are on that Friday in May. They're going back into hibernation mode. So it's just the nature of navigating what the Fed is going from just hyperinflation to now basically like a 2 to 3% inflation type number. It's losing the last 5 pounds. We're going to have trials and tribulations, but the reason we do this, for anyone watching, it's to navigate through it, because when the New York City cab driver is bearish on stocks, usually that's a good time to buy.
That's right. I love that part of it. So, look, we just gave you a really intense breakdown on what happened in April. Everybody looked at it's so funny how the media gets wrapped up in they're catastrophists, right? It's never going to be another down day, and then it's going to be we're in the middle of a bear market. Suddenly we can do that. What used to take generations to happen are now happening intraday. Yes. We can be bears at noon and bulls at 4 o'clock in the afternoon. That's unheard of. We could be in a recession and a depression, and then it's going to be the greatest market in history. So it's just this overreaction. Things are happening at an accelerated rate, clearly. We're living in that accelerated world right now, but it's so nice to get a breakdown from you and to understand what happened in April and what was going to happen. So sell in May and go away. An old Wall Street adage. I mean, what do you say to people who are going to follow that stream? Or
I disagree. If you look at the history of it, it's actually not, I wouldn't say the right strategy.
It hasn't worked that often.
And then you actually, within it, that doesn't mean that you can't buy tech and sell financials. There's component ways to do it. Look, I think you did a great job summarizing. Fed took that hike off the table. I always thought that was kind of a fictional Netflix type stuff. But regardless, took that off the table. Took talk of like stagflation off the table.
But you saw what he said yesterday on Wednesday? He said there'll be no stag and no inflation.
Exactly.
Right? Yeah.
Look, so the point is, this is not going to be a market that's going to go straight up and to the right. We're going to have some of this sort of turbulence as we get there. But if you look at tech earnings, you look at fundamentals, it's now setting up for what I believe is the next leg higher for tech and for the market, with essentially almost an all clear, in our view, post-Fed meeting.
Okay, so I've always thought, so in the last couple of years, I was sort of wondering, you've got, obviously there are hedge funds, institutions, brokerage firms like where you work that are usually long-term investing. They're buy and hold type of institutions. And what I kind of felt was going on in 2022 and 2023, 2022 was such a rough year. To eke out any kind of a profitability, it was virtually impossible. And I don't know how you guys performed in 2022, but I got this sense in end of 22 and into 2023, and some analysis and questioning that I did to some of the powers that be were that some of the big guys who were normally buy and hold were having to change their protocol to actually trade the market a little more to be able to eke out a profit in a year that was so volatile. Did you guys do that?
I think 22 relative maybe to 08 was probably the darkest year from an equities perspective.
Double digit down.
Because when the bond market rules the market, bond market says to equities, hold my beer. And you basically just, no matter what the fundamentals were, 23 more normalized, and I think 24. But the long-term investors, they have had to become more nimble.
Right.
And I think even what we looked at over the last week or two is a good example of it.
Right.
You look at tech, some of these moves that we've had the last 2 weeks are just jaw-dropping.
They are jaw-dropping, and I think, look, you saw reversals. Reversals get my attention. The reversal that we saw, and let's talk about Wednesday for a minute. So the Fed came out, obviously we didn't cut or we didn't raise, okay? He started to talk. He did say he took off the raise off the table, even though, and I think that was sort of like a black hole in the stratosphere. I don't know where it came from, and it doesn't make any sense. It was like when they started talking about cutting when we were not even done raising. Sure. They get ahead of themselves in a strange way, and then the whole descent amongst the ranks. But we saw the market rally really hard off of that bit of news. They got, basically the uncertainty got taken off the table, if that's what they were afraid of. But literally, what do you think happened? Correct. But what do you think happened the minute he stopped talking in the press conference? We rolled over and went down 80 or 90 handles within a half-hour period of time. Was that just getting back to where we came from, or this was just like a rational enthusiasm around the comment? How do you explain a reversal like that?
I think the statement was maybe viewed as more dovish.
Okay.
And the actual press conference was viewed as neutral to maybe a little more hawkish.
Okay.
So I think as that press conference went through, investors, the initial reaction was,
oh my God, it's all glee. It's
it's like, what do we do right now?
Right.
And I think you're seeing a market, and you know this better than anyone, that's selling strength.
Correct.
So I think some of it was that. Once the presser ended, you just saw those profits.
Right. I mean, it just evaporated. And I know, look, within electronic markets, you've got things when the sellers show up, the buyers evaporate. Right, because you're looking at the way the electronic markets work is you have like it's like a bowling alley in a way. You've got a queue, right, and then everybody's in there trying to buy it. When the sellers show up, they kind of evaporate, and the same thing on the upside.
As a side note, I could see you as a pretty good bowler.
I was once, but it was never something I spent a lot of time.
Did you ever have your own ball?
I never had my own ball. Now I'll tell you a funny story. There's an old story on Wall Street, which is kind of a curious story. But got back here on the floor of the stock exchange that all the guys used to have bowling teams, right? And this one story it was a curious tale of a guy whose wife had bought him a bowling ball for his birthday. And every week he'd go bowling with the guys. And then one day she decided that she was going to go bowling with them, and she showed up at the alley. And when he went to open up his bowling ball, the bag, and the holes had never been dug, and so apparently he had never been going bowling. He obviously was spending his time somewhere else. But anyway, there's a little old Wall Street story.
That's a good
What
story.
you made me realize why the market sold off that hard was there was one comment. It's fascinating. Everybody who's a day trader watching these, look, when at Wall Street Global, where I have an academy teaching people technical analysis, we will often tell people that, first of all, don't trade in anticipation of earnings, because as we just described, earnings can be good, guidance can be good, and it can come out and the market can go down 50 points, right? We've seen that over and over again. Earnings can be poor and the market can rally. So this is not your grandfather's stock market where, you know, earnings were projected to be good, and analysts like this wonderful gentleman would say, we're looking good, guidance is going to be good, you could buy the stock, earnings came out, it went up $4, you could buy into it, take your profits, it was all good. It's not happening that way. There's so many different moving parts in this game. So we always say, wait till the information comes out, and then let price action and technical analysis govern your entry point, because you're going to be lucky for $1 or wrong for $50, and we don't want that to happen. Same thing with Fed meetings. Sit on your hands coming into a Fed meeting. You may know what he's going to say and have an opinion about it, but the way the market reacts to it is there's no rhyme or reason to it. It's crazy. And that's what we saw then. I think the comment that he made that maybe made the market roll over at the end of the news conference was, he said, until I see us have a trajectory to 2%, I'm not cutting rates. You saw that. You heard that comment.
And I think ultimately the way that it goes back to this conversation.
Right.
The way you get there, you need a softer job market.
Right. Okay. So we just came. Look, we just
Full
did a
circle.
really beautiful
Totally.
full circle, explaining to you all why the market's doing what it's doing. I'm a forensic broker. He is a forensic analyst. At the end of the day, that is the key. It's all about information and edge to try and understand this, because economic data, look, is not how it used to be. I believe in a post-COVID world. Look, as I said, in a world where you can be actually technically in a bull market at 10:30 in the morning, and by dinner time you're in a bear market, all those terms of depression and recession are no longer relevant. Bulls and bears, it's no longer relevant. You've got to look into the nooks and crannies of the market and have somebody like Dan break down the economic data and the news and the way stocks react and the long global look.
And no one understands as well as you. I mean, you've seen everything, so you could compare over the decades how things have changed. And I think now it's just trying to have investors equipped to be able to pivot quickly on opportunities.
Exactly. Pivot quick upon opportunity. That's what we're talking about. And this is an opportunity. Look, there is nobody breaking down the market like the two of us. We love it. Einstein and Ives, Money News Network, and that's all we got to say about that. Boom!